Hello, Marc Ostwald from ADM Investor Services International. Thoughts on where we stand with the Fed and indeed other central banks in terms of interest rates, and whether they've fallen into a trap of their own making. So I have a table and three charts to look at this week. The first is a familiar one. It's market implied policy rates. As one can see in the columns in the middle, basically we're still exactly where we were, i.e. markets are not expecting interest rates to rise any time over the next 3-year time horizon, other than in a couple of emerging market countries, but in the developed world, certainly not. So one would basically hope that that fosters good financial conditions for the economy. My second chart is US investment grade versus US high yield credit spreads. Again, another familiar chart, as one can see. Basically, having had that big spike in the March-April time, we've now come back to the levels which are in principle basically normal. They are slightly elevated relative to where we were in the second half of 2019. But then again, one would have to observe that we've had already record issuance in both sectors this year, well in excess we had over the last 3 to 4 years. And we still got 4 months to go, and we've had a record August already with 121 billion corporate investment grade issuance. All sounds good. My third chart is an interesting one from the perspective that there was some disappointment this week that the Fed wasn't committing to more measures. So this is the Fed. Basically, it basically tells us a story that the Fed is under no current pressure, as one can see, basically from the market implied interest rates, from the shape of the US Treasury yield curve, which has steeped very modestly, but in the face of record US government issuance, record corporate, one would say that the steepening is very, very small. The Fed's balance sheet is around the 7 trillion mark that it's been effectively since the end of April. Will stay that way unless they find themselves in a situation where the economic situation is deteriorating. So we then come to my final chart, and I think this is the important one, because as much as the Fed policy review, which will be announced by Mr. Powell at the Jackson Hole Symposium at the end of August, is basically seeing how they might rejig the inflation and employment targets that they have, their so-called dual mandate. My argument would be actually that they've been targeting US financial conditions, and I would suggest that this is also the case with all other central banks, for a very, very long time. As one can see, financial conditions are basically back to the sort of levels that they were pre the COVID crisis, and volatility, which is a key component, has also dropped off. The problematic with this is the financial conditions that we're talking about here are market financial conditions. They're not mainstream conditions. It doesn't really tell us anything about credit availability to the or to small and medium-sized enterprises. It merely tells us that there's no stress in financial markets. Well, with the Fed having increased its balance sheet the way it has, it's not. The problematic with it is that every time the market has a funk, the Fed is effectively forced to increase its balance sheet, reduce rates to zero, but it doesn't actually benefit the economy. And this is basically something which I think is going to become more and more problematic as we go through the year, unless we see a marked upturn, which doesn't seem very, very likely. Those are the thoughts for this week.